Welcome, dear traders. Trading floors in the United States are closed today. Nevertheless, looming recession risks still pose a threat, and the Asian stock market was trading lower because Wall Street futures are yielding lower gains. Hawkish stance of a major central bank sets the stage for a crash across global stock markets. Investors are especially alarmed by statements from Fed policymakers about the crusade against inflation. The last week was rough for the US dollar. On Wednesday, its index leapt to 105.70, the level unseen since late 2002. Then the index fell steeply off the 20-year peak. Nevertheless, the greenback rebounded by the weekend and regained half of its losses. After such a roller coaster, the US dollar is taking a breather. Today, American markets are closed on the occasion of the national holiday, Juneteenth. In the Asian session, the US dollar index fluctuated marginally against the six major currencies at 104.38. The index is now consolidating at around 104.28 and 104.82 with a bearish bias. Though the greenback is trading sluggish today, it still finds solid support from expectations of a further aggressive tightening by the US Fed. Higher volatility in the US dollar is expected on June 22, when Jerome Powell will deliver a speech in front of the Senate Banking Committee. The Fed's chairman will give his twice-yearly report on a monetary policy. If the market finds evidence of a further tightening, the US dollar could assert strength. The Bank of Japan's ultra-soft monetary policy has proven the most efficiency among other major central banks. Inflation in Japan has already exceeded 2%, and this figure is way more modest than the CPI at 8.6% in the United States and 9% in the UK. Inflation in Japan is driven mainly by external factors such as the global growth in energy and food prices. Excluding these factors, the core CPI is measured at 0.8% on year. Japan's central bank has no reason for panic. Traders speculated that the Bank of Japan would give in to the market pressure and fine-tune its particular monetary policy, but their speculations did not come true. Nevertheless, soaring inflation is raging across the world, so the Bank of Japan could revise its monetary policy. Even the rock-solid Swiss National Bank ventured into the first rate hike in 15 years. Analysts do not rule out a revision in Japan's monetary policy. If so, a sharp change in yields of government bonds could explode global financial markets. It's still early for that. Meanwhile, the regulator is taking precautionary measures. Lately, yields of its 10-year bonds rose above the acceptable level of 0.25%. To push it down, the central bank came up with an unprecedented move and bought bonds worth $80.8 billion last week. In this context, the yen is trading at about 134.72 on Monday, without any support from its regulator. Amid the polar opposite policies of the US Fed and the Bank of Japan, the US dollar advanced 2% against the yen on Friday. Today, the selling pressure is for the yen on the back of the public holiday in the United States. Thus, the yen could recover a bit, trading in the corridor between 134.50 and 135.43. The currency pair is about to test a one-year high of 135.59. While the yen is getting weaker due to ultra-loose monetary policy, the Australian dollar has fallen prey to external headwinds, in particular the US Fed. The Aussie is sensitive to developments in the US stock market and policy moves of the US Central Bank. Today, the AUD-USD pair is trading higher inside the corridor between 0.6918 and 0.6990 because of the thin American market. Besides, we should not neglect economic jitters in China due to the COVID outbreak. It means backlogs in a long-term contracts in supplies of Australian commodities to China. A trade volume is also dwindling. Despite such headwinds, the Australian dollar advanced against its American rival to 0.6983 today. Let me remind you that our analysts are ready to answer all your questions and comments. Stay tuned and follow developments in financial markets on InstaForex TV channel. See you online later.